Thank you, Peter, and thank you very much for your interest in the Switzer Dividend Growth Fund. My name is Marcus Bogdan. I'm the Chief Investment Officer and co-founder of Blackmore Capital, and we're the portfolio manager for the Switzer Dividend Growth Fund. Today, I'd like to cover off on three areas. Firstly, a background of our investment heritage, the investment methodology which we apply, and our investment objective of the Switzer Dividend Growth Fund. Then I would like to turn our attention to the Australian equity market and what we're seeing as the core drivers there and the outlook. And finally, I would like to touch on the Switzer Dividend Growth Fund, the composition of the fund and the drivers of the return and the dividends that we expect going forward. So our investment heritage as investment managers goes back 30 years. I commenced my career in the early 90s, and for over those 30 years, there have been periods of deep crisis in all of our equity markets, starting with the recession of the early 90s when interest rates were above 10%, to the global technology crash that we saw in 2000, followed by the global financial crisis in 2007, and then finally the pandemic, which we experienced in 2020 and is still ongoing. And it's important as an investor to be able to navigate through all seasons and through all markets. And for that sense, our investment methodology is particularly important. Our investment universe is the ASX 200, where we have an emphasis on quality earnings, because quality earnings translates into more resilient returns that are capable of withstanding poor economic backgrounds, and also the delivery, and most importantly, the delivery of quality dividends. We also place a great consideration on conservative balance sheets, because conservative balance sheets allows companies to invest counter-cyclically and also provides a bedrock to providing resilient dividends. And that lends us to our investment objective of investing in quality companies where our focus is on delivering total shareholder returns, both in capital and dividend growth, and being able to deliver that with lower volatility. If we turn to the Australian equity market and where we are in the equity market profit cycle, because ultimately it is earnings that drive equity markets, and it's ultimately that earnings that drive strong and sustainable dividends. It has been a remarkable 18 months, going back at the beginning of the pandemic in February and March 2020. Within a month, we had a contraction of the share market of around 36% and a collapse in earnings and dividends of around 30% in that period of time. But very quickly, with a rapid response, both in monetary policy and by fiscal policy, and then later on with a successful vaccine, we've staged a remarkable recovery. Share markets have recovered to be beyond where they were pre-pandemic, and the earnings cycle has recovered handsomely. In 2021, we saw earnings growth of around 25% and an uplift of dividends of 30%, as markets started to truly recover and earnings recovered from those pandemic lows. In FY22, the financial year that we're in today, we do expect that earnings and dividend growth will moderate, but importantly, we remain in an earnings cycle upgrade. We expect earnings growth of between 10 and 12% this financial year, and that will be accompanied by dividend growth of a similar amount. Balance sheets for Australian corporates remain in remarkably good shape, being able to deliver and underpin both earnings and dividends over that period of time. It has been pleasing what we've seen in the most recent first quarter profit updates and also in the most recent AGMs. We've seen a number of companies upgrade their earnings, and companies that we have in the Switzer Dividend Growth portfolio include Helios, Australia's second largest pathology company, upgraded earnings significantly, being a beneficiary of PCR COVID testing. We also saw an upgrade in Goodman Group, the industrial property group, that upgraded earnings from 10% growth in August to now expecting earnings growth of around 15% for the full year. Macquarie Bank also upgraded their earnings guidance. And finally, Medibank Private, which has been a very stable dividend payer for the fund, upgraded their guidance in terms of what they're seeing in customer acquisitions. And we then saw companies reaffirming their guidance. Bellwether companies such as Amcor, Brambles, and CSL, all illustrating both revenue and earnings growth for the coming financial year. There were some areas of disappointment. The materials sector has been affected by a slowdown in Chinese economic growth, and that has impacted commodity prices. And more recently, we've seen a disappointing earnings season for the banking sector, particularly with CBA and Westpac. Ironically, it was the banks and the materials sector that drove the strong earnings growth in 2021. But that pattern now is changing for this financial year, where we expect to see solid earnings growth from those core industrial companies in the Australian equity market, good returns from the telecommunications sector, and also from the REIT sector. So we remain positive on the market, given the fact that we're still seeing earnings growth at above average rates. And we expect to see that growth of around at least 10% for this financial year. An area of focus and an area that we are overweight in our equity portfolio is in healthcare. Healthcare was dramatically impacted by the pandemic, with either patients not being able to see GPs face-to-face, the cessation of elective surgery, and a whole range of testing which was postponed because of the pandemic. The backlog there in patients is significant. This is a global phenomenon, and we expect as we move out of the lockdowns, particularly on the eastern seaboard, we will see a strong and sustained recovery in healthcare revenue and in earnings. The second area why we're overweight healthcare is that we are in an ageing demographic where the need for ongoing healthcare is absolutely paramount. And thirdly, there is a rise of chronic disease as well. So in summary, the three areas of why we do like healthcare to deliver superior earnings and dividend growth over the forecast period relate to the backlog in patients from COVID and the drivers of both the ageing demographic and chronic disease driving a very strong earnings and dividend growth profile over the coming years. If we could now turn to the Switzer Dividend Growth Fund. With earnings slowing but still being positive, interest rates being near record lows, there is an increasing focus on income. Australia is an extraordinarily attractive place for investors to derive share dividends, but primarily because we have the second highest in the developed world in terms of dividend yield, just behind Singapore in the developed world. And that has been an area that we have prominently been able to deliver very solid dividend yields for investors throughout history. Our payout ratios are sustainable and attractive, and we also have the benefit of franking, which is idiosyncratic to the Australian market. Our approach to dividend investing is not purely focusing on the highest dividend yield companies in the market, because we need to ensure that dividend income is resilient and can grow over time. A focus on just the highest dividend yield can be fraught with danger. Most recently, AGL at the beginning of this year had the highest dividend yield in the ASX 200, but has delivered the second worst return in the ASX 200 this year. If we go back further in history, around the Royal Banking Financial Royal Commission, we saw that the dividends in the banking sector, whilst at face value looked attractive, they were unsustainably high. Dividend payout ratios were 90% or above, and there was a requirement for additional capital requirements and higher expenses. Subsequently, we saw a reduction there in dividends and a reduction in payout ratios. But today, those dividends are far more sustainable, and the banking sector has a far more robust balance sheet. Or if we turn to Telstra several years ago, it was paying a dividend of 32 cents a share. Through the impact of NBN and competition, that dividend was cut from 32 to 16 cents today, which we now believe is underpinned by a far more substantive financial model. So it is important to look underneath the level of the dividend yield to ensure that the earnings and the balance sheet of those companies are robust. And we look at dividends in three categories. The first category is, of course, we want to have a range of companies which pay high dividend yields, but they need to be sustainable. In today's market, there are areas where we can capture those high dividend yields, primarily in the banks, which have got far more conservative payout ratios, around 70%, and unquestionably strong balance sheets. In companies such as the property sector and the REIT sector, where we can see dividend yields of 5 to 6%, which we believe can grow over time as well. The second category that we look at is companies which pay a slightly lower dividend yield of around 4%, but those business models are incredibly sustainable. Companies like Amcor, Brambles, Woolworths and Wesfarmers have been able to deliver earnings and revenue growth throughout the economic cycles, and to be able to deliver both superior earnings and dividend growth through the investment horizon. And then we have a small group of lower dividend yielding companies, but those companies are growing their earnings at 10% or more. And so we expect to see the subsequent increase in dividends over time of double digit. And a classic example of that would be companies like Cleanaway, Australia's largest waste management company, and companies like CSL, which has been a bellwether healthcare company that throughout history has been able to deliver double-digit earnings per share growth and dividend growth. So thank you very much for your attention today and your interest in the Switzer Dividend Growth Fund. Thank you.